Good afternoon. Good evening, everyone. Welcome to our class this evening. We appreciate you all taking time out of your busy evening to come and learn about comparing mortgage loan options. For any of you all that are going through the home buying process, this is a very important class for you all. So I hope you all have your pen and paper and you're prepared to take notes because we have an excellent speaker for you all this evening. It gives me great pleasure to introduce one of our partners at First Horizon. His name is Daniel Garcia, and Daniel is the Vice President and CRA Lending Officer with First Horizon Bank. Daniel is such a great partner of ours, and he's so educated about the home buying process. He's been doing this for a while, and he can tell you all the ins and outs, the ropes, how to, just how to do everything and make sure you are prepared for that home buying process and just getting into a home in general. So you all are in great hands with Daniel, and we are going to be very mindful of everybody's time. This class, we've allotted an hour for it from 6 to 7 p.m. If we have the time, we will be able to take some questions at the end. So if you have questions, I'm asking that you all jot those down in the chat. Like I said, we may not be able to get to all of them, but hopefully we're able to get to some of those, okay? But again, take notes because this is a good one for you all. And with that being said, I'm going to go ahead and pass it on over to Daniel so he can give you all a little more information about himself and give you all the great information on comparing mortgage loan options.
Thank you so much, Aretha. I am so happy to be here this evening. I say this to every class that I present with you guys is that this is my favorite part of my job. Being able to educate families and people on how this process works, because it can be a pretty cumbersome process, kind of scary sometimes too. But hopefully you'll get to learn a little bit tonight, and it won't be as scary. If we have time, we'll have some question and answers. But if we don't have time, Aretha can definitely get those questions over to me and I can get those answers out to you guys. So what we'll go ahead and do, let me get my screen shared over for you and then we can go from there. All right, are you guys able to see my screen?
Yes, we are.
Okay, perfect. All right, so comparing loan options, how to identify the best loan. So basically what we're going to do is talk about some of the loan terms that you're going to be running across when you go speak to a loan officer. You're going to hear these things and sometimes you may think, oh, well, what are they talking about? So the first one we have principal. So when the term that we typically hear is principal and interest, right? So you probably kind of know what that is. Principal and interest is the amount that you purchase, or excuse me, the amount that you borrow, the loan portion. So that's principal. Interest, or the interest rate. The interest is basically the charge that you're being charged, or the fee that you're being charged to borrow the principal. Interest rate, that's the often expressed as a numerical number like 3%, 4%, 5%, 7%. Typically, when they're giving you these interest rates, it's what's the cost of being able to borrow that principal over a time period. So when we're talking about annual percentage rates, APR, this right here is the cost of financing. So the best way to describe this, or the best way to use an APR, is to use it as a comparison tool. So when you go and talk to a loan officer at one bank, they'll let you know what your interest rate is, your APR, and then you go to another bank and talk to a loan officer about the same kind of mortgage. They're going to give you the interest rate and the annual percentage rate. By comparing the two, you're going to see who's giving you the better option, right? So oftentimes you may go to one bank and say, okay, their interest rate's a little bit higher, but their annual percentage rate is lower than the other bank, even though the other bank's interest rate is lower. Oftentimes what that means is that you're being charged more fees. So the really good way when you have the annual percentage rate, the interest rate, you're looking at these things. Those are really, really great ways to determine where you're getting the better deal. Looking at the annual percentage rate. So the annual percentage rate, again, is the cost of the entire mortgage, what it's going to cost you, expressed in a percentage. Okay, so it does include the actual interest rate when they're calculating the APR. Loan to value. So you have your loan, and then you have the value of the property. So what it is the percentage of what the loan is compared to the value. So for instance, if you have a 100% financing, or excuse me, you have a loan at $100,000, you're putting 5% down. So what's left? You've got 95% left of that mortgage, right? So that means your loan to value is 95%. So you'll hear that a lot. So oftentimes when you're talking to a lender about, and they mention loan to value or something like that, it's basically it's the percentage expressed minus your down payment. So again, if you go in with $100,000 on a loan amount, or excuse me, on a purchase price on a home, and then you put down 5%, the remaining amount, the 95%, that's your loan to value. Maybe you're putting 3% down, so then your loan to value would be 97%. If you're putting 20% down, your loan to value would be 80%. So it's the loan amount compared to the value of the purchase price, loan to value. So you'll hear those all the time. Amortization is the schedule that what you can actually ask for when you go and apply for a mortgage is what's called an amortization schedule. So what that is it breaks out how much you're going to be paying in interest and what portion of your payment goes towards interest for the entirety of the loan. So on this amortization schedule, it'll break down. Let's say you have a 30-year loan, that's 360 payments, right? So on this amortization schedule, it'll break down every month you make a payment, how much goes to principal, how much goes to interest. So it's an amortization schedule. Amortization means, or basically the loan being amortized over 30 years. So you're paying this loan back on a specific term. So it's amortized over that specific term. So you're breaking up interest and you're breaking your payments over that specific term. So 30 years, 15 years, 20 years, however long type of mortgage you get. Next thing we want to talk about, equity. This is important because this is how you're going to build wealth, right? So buying a home is probably going to be the largest purchase or largest investment you'll ever make. And most of us, this will probably be the largest investment we'll ever make, buying a house. So when we talk about, okay, you're building equity, or how much equity you have in your home, this is a way you're going to build your wealth. So equity is basically the difference between what you owe and what the value of your house is. Now, you remember, we kind of touched a little bit on this on the loan to value part, remember? It's kind of the same thing, but it's the actual difference, right? So the loan to value, we talked about what's left over. The equity is the difference between what you owe and what the house is worth. So going back to that original example of 100,000, just to make it easy, your down payment typically will equal the automatic equity that you have in the house, because the loan amount's 95,000, the value of the house or the sales price is 100,000. So you put 5,000 into it, you got $5,000 in equity. Now, what's great about this is that if your house values keep going up and you keep paying down your mortgage, that gap gets bigger, right? So that gap is what's considered your equity. So, if you bought your house for 100,000 and then now you only owe $60,000 on it, then you have $40,000 in equity. Or actually it could be higher because, as time goes on, the value of the house increases. So let's say you bought it for 100,000, you owe 60,000, but now the house is worth 150,000. Can you see how much equity you have now? Can you see how much wealth you've built through that? So that's what's important. This equity is very, very important when you're buying a house, something to consider, because that's what you're going to build your wealth. That's how you're going to have your wealth increase, by building the equity in your home. So that's why it's important when you do purchase, you get a good loan, but you also maintain your property, maintain your home, maintain the property values and all of that within your home, maintaining it. That's very, very important. And continue to make your payments, even throwing extra towards the principal to pay down what you owe. That builds, all of those things build equity. So we talked about all of these things here. So now let's touch on the types of mortgages that are out there or that are available to you. Okay. So the first one, we have a conventional loan. So any loan that is not government backed is considered a conventional mortgage. So again, any loan that is not government backed is considered a conventional loan. So when you go, that's the conventional mortgages are pretty popular because they tend to have less requirements when it comes to property conditions and things of that nature. Now, sometimes conventional mortgages can be a little bit more tough to qualify for because their interest rate, the credit score requirements may be a little bit higher. The credit risk analysis on your credit report may be a little bit more in depth. You might have private mortgage insurance on it. It may be a little bit more expensive. If you have a lower credit score, the private mortgage insurance can be more expensive. The interest rate can be higher. So, when you're talking to your loan officer, ask them about the different options that's available for conventional financing. But again, conventional loans are any type of mortgage that is not government backed. So when we talk about government backed, one of these types of loans is FHA. This is a loan through the Federal Housing Administration, which is backed by HUD. So it's the Federal Housing Administration falls under HUD's guidance. So it is a government-backed mortgage. Now, with an FHA mortgage is probably one of the most lenient types of mortgages in the market right now. What I mean by that is that it's easier to qualify for an FHA mortgage because FHA guidelines they're not as stringent as a conventional mortgage would be. For instance, FHA requires a 3.5% down payment. With FHA, when we talk about debt to income ratios, and I think we'll touch a little bit on that here shortly, but what debt to income ratio is the amount of your house payment plus your monthly debt. How much of that is allowed to go toward, or can you use of your gross monthly income? So with FHA, you can go up to 56.99%. So that means of your gross monthly income, 56.99% of your gross monthly income can go towards your house payment and your monthly debt. Now with conventional, they're typically capped off at 50%, some are at 45%. Some are even less than that, to like 43%. So when that happens is when that debt to income ratio requirement is lowered, that means your affordability or the amount you qualify can be lowered as well. So with FHA financing, with the ability to go higher on that debt to income ratio, you're able to qualify for more of a home. Now, with that being said, FHA is also a better mortgage product for those who have lower credit scores. And when I say lower credit scores, I would say anything under 700 nowadays, you're probably going to only qualify for conventional financing, or FHA financing, because they have the easiest terms to qualify for. FHA mortgages can actually go down to 500 on the credit score with a 10% down payment. If you want the minimum down payment, FHA only requires a 580 credit score. Now, with that being said, just because FHA allows a potential buyer to qualify with that low of a credit score doesn't mean that the lender is going to allow it. So it's important that you shop around. Not all lenders are made the same when it comes to their guidelines. Some lenders have what we call overlays. So in other words, they have guidelines on top of the bare minimum guidelines. So if FHA says, okay, for a 3.5% down payment, we require a 580 credit score, no less than that. A bank may say, well, you know what, we want to, that's a little too risky for us. So we're going to actually cap that at 620. So you have to have a 620 or higher. Some lenders will say, you know what, 600 or 640. So it just all depends on the lender that you're working with as far as what they will allow. But FHA mortgages are great mortgages for those who may be a little bit credit challenged. Um, Again, the ability to qualify for more with an FHA mortgage is there. So, you know, ask your loan officer about it, talk to them about that. Now, if we've got any veterans in the class tonight, this is a very, very great mortgage for you. And you probably already know about this, a VA loan. So if you've currently serving in the military or you've been honorably discharged and you have eligibility through the VA to purchase your full eligibility, then you could buy a home with zero down. So in other words, there's no down payment requirement on VA financing. So again, it's one of those, so VA doesn't have a minimum credit score requirement. VA does not have a maximum debt to income ratio requirement. Now, again, going back to what I said earlier, just because they don't have those minimums doesn't mean that the lender won't. So check with your lender. But VA is a great program for our veterans and for those who are spouses of veterans, and for those who are actually currently serving. They're amazing programs. And if you're a veteran or if you're serving or something, you know, this is a great program. It's 100% financing, so there's no down payment requirement. The only thing you would be responsible for covering would be your closing costs. Another program that is really good program, USDA. So USDA is a great loan option for those who are buying in what's considered rural areas. So with USDA, there is no down payment requirement as well. So what that means is that's 100% financing. All you would have to cover would be your closing costs. Now, with any of these mortgages, and I didn't mention this earlier, the seller can come and pay some of those closing costs for you. So you can see how potentially you can get into a home with these 100% financings with very minimal money out of pocket. So there's several caveats to USDA. USDA does have a income limit, so you can actually go to USDA's website and look up the income eligibility. You put in an address and it'll tell you how much income someone can make to purchase a certain home. But now USDA is also geographic restricted. So in other words, you're not going to use USDA financing if you're buying in the city limits of Dallas. Now, if you go out towards Terrell or Kaufman or you know, somewhere on the outskirts, there may be those are USDA, potentially USDA areas, because USDA has specific geographic areas, and I think it goes by population and whatnot. But if this is an option, if you're looking on buying on the outskirts of the DFW market, this may be a good option for you looking at USDA financing, because the interest rates are good, low down payment. Again, you have to be income eligible. You have to purchase in a specific area. USDA is very, very tight on their debt to income ratio. So you pretty much have to kind of fit in their box. But if you can fit in that box and qualify for USDA financing, I think it's an amazing program that you can take advantage of. First-time homebuyer programs. So now, when a lot of people talk about first-time homebuyer programs, they think there's a lot of people think there's a specific mortgage specific to first-time homebuyers. Now, that may be the case, but when we talk about first-time homebuyers, there's many mortgages out there that are great for first-time homebuyers, but not specific to first-time homebuyers. So, for instance, FHA financing, great program for first-time homebuyers. Conventional products. If you go with the conventional loan that's through Fannie Mae or Freddie Mac that your lender is working through, they have an amazing program with 3% down that you could qualify for. Now, you do have to be income eligible for those, but it's not specific to first-time homebuyers. Now, there are those conventional products through Fannie Mae and Freddie Mac that have 3% down requirements, as low as 3% down. You do have to be a first-time homebuyer, but there wouldn't be any income restrictions on it. So when we talk about first-time homebuyer, first off, let's think about what is a first-time home buyer? Is it somebody that's never bought a house before? Yes, that's true. But the guideline specific to first-time home buyer really just means if you haven't owned a property within the last 3 years. That's what's considered a first-time home buyer. So if you've bought within, if you haven't owned a home, if you bought, 10 years ago and you sold it or whatever, and you haven't owned a home within the last 3 years, you are considered a first-time home buyer. Now, again, there's a lot of programs out there that you can look into to qualify for some of these programs. Just because, you can look into these other programs that may not specifically be just for first-time home buyers, but they're great programs that would be for first-time home buyers. Portfolio lending. The portfolio is basically a bank or lender's their own mortgage loan, their own mortgage product. So when you think about it, so FHA, USDA, VA, some of the conventional loans that are going to be, sold off to Fannie Mae or Freddie Mac, those are secondary market loans. So portfolio would mean I, as a bank, loan you this money and you will continue to pay me because it's my loan. I don't sell it off to secondary market. You just qualify per the guidelines that I set as a lender. That's what portfolio loans. Now, portfolio loans are typically with banks. Usually, banks are usually the main ones that have these type of loans. So they'll have different programs available, different products and things like that for that would not quite meet regular conventional guidelines. For instance, there's several banks that have 100% financing. Great example there. Now, no other secondary market lender, FHA, VA, USDA, well, I get VA and USDA do, but when you talk about conventional financing, there's really not a secondary market out there for 100% financing. A lot of the banks that do offer those type of loans, they're usually portfolio loans that are kept within the bank's books. So those are some programs that you could even look into. Kind of see what would be available. Some lenders have great programs, no PMI, things like that, great interest rates, fixed rates. So definitely talk to a loan officer about that. So fixed rate versus adjustable rate mortgage. So as first-time home buyers, I would highly recommend that you go for a fixed rate mortgage. A fixed rate mortgage is a mortgage where your interest rate does not fluctuate throughout the period of the loan, throughout the time of the loan. So if you go in with a 6% interest rate and you close with a 6% interest rate, and you get a 30-year mortgage, for 30 years, your interest rate's going to be 6%. The only thing that does change when we talk about payments and stuff is if you have your taxes and your insurance escrowed into your monthly payment, then, if the taxes and insurance fluctuate, then your payment would fluctuate. But as far as the principal and interest portion, because you have that fixed interest rate, it would never change. Adjustable rate mortgage, you go in, close with an adjustable rate mortgage. Sometimes these adjustable rate mortgages come in with a lower rate, but then they're fixed for so many years and then they start fluctuating with the market. I wouldn't, if you're a first-time home buyer, I wouldn't recommend doing an adjustable rate mortgage. Typically, the ones that I've done these type of loans for are those who've already on their 4th or 5th house. They're coming in and they know they're not going to live in this house, but maybe 3 or 4 years. So they'll get an ARM that's fixed for 5 years because they know they're going to sell it before it adjusts. Those are the type of individuals or families that those type of mortgages are for. But if you're first-time home buyer, stick with that fixed rate because you don't want anything, to come up. So just keep that in mind. Subprime mortgages, these are starting to kind of creep back into the market. I don't know if you heard or if you've done a lot of research or whatever, back in the crash of 2007, 2008 was a result of a lot of these subprime mortgages. Basically, back then, if you had a pulse, you could get a loan is what it came down to. Nowadays, you're going through a lot more qualification and a lot more review to even get the mortgage. But there's some mortgages that are coming out that are considered subprime. But these are for those who have really, really high credit scores, have a lot of money in the bank, but maybe they can't quite prove their income or something like that. So there's some type of compensating factor that would allow them to get this type of mortgage. And that's kind of the main one. There's things called bank statement loans where, if you have a someone who's self-employed but doesn't show a lot of income on their taxes, then the lender will say, okay, you got a really high credit score, you got a lot of money in the bank, you're putting a big down payment. We'll go off your income based off the bank statements that you have showing in your account that comes in. So those are considered subprime mortgages. I wouldn't recommend these type of loans for you guys if you're first time home buyers. They do tend to require a lot more down, and these subprime loans are a lot of times they're going to be adjustable rate mortgages. So I would kind of stick with, kind of go towards those fixed rate mortgages. Those are the ones that are really going to, I think would be best for you, be in your best interest. All right, so loan costs and what do they include? So I don't think this particular presentation goes into it much, but I'm going to touch on it. So I approached this with some of the other classes that I teach. How much do you think you're going to need to purchase a home? A lot of people think, probably need 20%. I need, $5,000, $10,000, $20,000, however much. But then we get into the mindset because we start talking to our loan officers and start hearing about all these down payment assistance programs and things like that. So then I pose the question again, if you're getting these types of assistance, then how much money do you think you'll need in your bank account? So sometimes I'll have people, come in and try to qualify who want down payment assistance and they know they can qualify for it, but they've only got $100 in their bank. Well, to put it plain and simple, that's not going to work. I'm going to say that you're going to need anywhere from $3,000 to $5,000, even if you're getting down payment assistance, because there's going to be upfront costs and things that you'll have to worry about, that you have to take care of, and that you're going to have to show that you have the ability to take care of those. But loan costs, let's talk about those. First thing is down payment. Down payment, most of us probably know what that is. That's the investment part on your end that you have to put into the transaction, whether it's, the FHA 3.5%, whether it's, regular conventional at 5%, or you're getting one of those special programs with 3%. That is a cost that has to be covered, as well as closing costs. Closing costs would be the third-party fees and the prepaids and all of the fees that are involved with closing on this mortgage or with this transaction. Those are going to be all of the fees that you'll have to cover as well. So just kind of backing up a little bit. Now, what if you get qualified for one of these zero down programs? You're still, even though you won't have the down payment, you're still going to have closing costs that you'll need to cover. And that can come from gifts, depending on the mortgage that you're getting, gifts from family members, as long as it's verifiable. If you're using 401k, if you sold a car and you got proof that you sold it, or the seller can even cover some of these closing costs. I'm seeing that a little bit more nowadays because the market's kind of changing a little bit. The next thing you'll need to cover are reserves. Now, this is, I don't know that you would really have to worry much about reserves, but I'm going to talk about it. We're going to talk about it just in case. So reserves are the money you have left over after we've calculated your down payment and your closing costs. So when a lender is going to require reserves, they're going to say, okay, your down payment and your closing costs is $10,000. We need to see that you have 2 months of reserves. So what that means is that they want to see that you have 2 months of house payments in your bank account after they've subtracted out the estimated cash to close, which would be your down payment and closing costs. Now, some mortgages require it, a lot of mortgages don't. Basically, it's just what you have left over after they've calculated your down payment and your closing costs. So typically they want to see enough in there to cover 2 or 3 months if they are going to require it, depending on the type of loan you get, the property, and all of that stuff. But it is important to remember to think about it. Now, another thing to even consider, the more reserves you have, even if you don't need it and the loan doesn't require it, that could be a compensating factor for the lender approving your mortgage, because that means there's less risk. That means that if something were to happen, you've got some money to fall back on to make your payments. So it could be a good thing if you have reserves, even if they're not needed. Escrow. If you're paying taxes and insurance included with your house payment, you're going to have an escrow account. That's what it is. An escrow account is what holds the taxes and the insurance portion of your monthly payment. So every year you make 12 payments a year, right? And your taxes and your insurance are included with your monthly payment. So let's say you got a $1,500 a month payment, and let's say 400 of that goes towards your taxes and your insurance. Okay. So every month you make that $1,500 house payment, they're going to take that $400 that goes towards your taxes and your insurance and put it into this escrow account, so that at the end of the year, when your taxes come due, we've already got that money saved up for you. Okay. You've already made those payments. They'll take it out of the escrow account, pay those taxes. When the insurance comes due, they'll take it out of that account and pay the insurance for you as well. So that's what's called an escrow. Okay. Earnest money deposit. Yes. So this is actually one of the upfront fees that you're going to have to cover. So remember the previous slide, or well, it's not the previous slide, it was this slide, where it said that, how much money you were going to need to have. And I said anywhere from $3,000 to $5,000. That's because you're going to have the upfront cost, the earnest money deposit. Now, an earnest money deposit is a deposit that you give. So when you go find a house, you're looking for a house, you find a house, you put in an offer, the seller accepts your offer. The seller is going to require that you give an earnest money deposit. So it's like a good faith deposit. So you're going to go deposit that money with the title company so that the seller can take it off the market and give you an opportunity to purchase this home with your financing. So it is an upfront cost that you're going to have to cover. I'm not sure if we're going to cover this other one, like an option fee is another upfront cost. That gives you so many days to get the house inspected and whatnot, and you really determine whether or not you want to purchase the house, and then you can back out of the contract and take keep your earnest money without risk of losing it. That's another upfront cost. There's also appraisals. You'll have to cover appraisals. Most lenders charge appraisals up front once you get under contract to be able to get the value of the house to determine, is this really, is this house really worth what you're trying to buy it for? Inspections. You're going to want to inspect every house, right? So you can see, coming to us to try to get pre-approved and you only got $100 in your bank account, it's probably not going to work, even if you're getting all this down payment assistance, because all of those assistance to help cover the down payment, the closing costs, the reserves, help set up your escrow account, all of that comes into play at the end of the transaction. So on the day of closing is when those monies come in to cover these other things for you. So you're going to have some money up front to cover the upfront costs to buy a house. That's just the way it is. Points. Okay. So in this market, especially with rates being so high, this has become kind of a hot topic, points. When a lender is quoting you an interest rate and you don't like that rate, and you want to get a lower rate, then you can pay quote unquote points. 1 point equals 1% of the mortgage, or 1% of the loan amount. So if your loan amount's $100,000, 1 point would equal 1% of that. So that's $1,000. So let's say, you want to lower your interest rate from 6.25, well, actually they're higher now, 6.5 down to 6.25. The lender says, okay, I can do that, but you're gonna have to pay a fee or pay points of, 1.25%. So you're gonna pay 1.25% of the loan amount to get that lower interest rate. Those are a lot of the things that are happening nowadays because the rates are getting so high. Now, there are some mortgages where just to even get an interest rate, because they're high, you're going to have to pay points. So that's why it's important that you shop around, because not every lender is the same when it comes to how they're pricing. They may be similar, but some may be better than others. Appraisal, we kind of touched on what that is. It's an appraisal fee that you're going to be paying up front. I guess I jumped ahead of myself. Sorry about that. So appraisal is it's basically a market analysis of the property to determine the value of the home. So as a lender, we want to know that the house you're paying $100,000 for is worth $100,000. That's the whole purpose of it. Okay. But it is something that you pay for. And of course, you as the consumer, as the buyer, you want to know that the house is worth what you're paying for, right? So an appraisal is very, very important. 9 times out of 10, the lender is going to require an appraisal. Sometimes you can probably get away with, the lender may not require an appraisal if you're putting a lot of money down and you got a lot of reserves and you got a really high credit score. They may say, okay, you know what, we won't go that far, but you're probably going to have it. Okay. Let's see here. Okay. Private mortgage insurance. So anytime you put less than 20% down, you're going to have what's called private mortgage insurance. Private mortgage insurance is not the same as homeowners insurance. Okay. This is a completely separate insurance policy. Private mortgage insurance protects the lender if you were to go into default. Okay. And it is something that's typically charged to you as the buyer or as the borrower in your monthly payment. So what that does is, let's say you get behind, the lender has to foreclose on your property. It costs a lot of money to foreclose between legal fees and then, upkeep and all of that just to get the home back. What the lender will do is, if you've got private mortgage insurance, they'll file a claim on that mortgage insurance to help cover some of that loss that they took in order to to foreclose on the property, because it's expensive. Now, you're probably thinking, well, why in the heck do I want to pay for this? Why do I have to pay for it? Well, simple answer to that is either you put 20% down, who's got 20%, or get in with with the 3% or the 5% and pay the private mortgage insurance. So what it comes down to is that having the private mortgage insurance is what allows you as a consumer to get into the property with as little money down. Okay. Now, just with that being said, not all mortgages have private mortgage insurance. There's different options on how to get rid of it and how, what mortgage has it and what doesn't have it and things like that. But it's there. Okay. So there's some, when we talked about portfolio lending in the previous slide, there's some banks that have programs that are specific to what we consider low to moderate income buyers or first-time home buyers, that they have these special mortgages where they don't have private mortgage insurance. Now, the purpose of that is so that it helps your affordability, because the private mortgage insurance can be anywhere from $130, $150, I've seen it even $225 a month. So can you imagine how much more you could qualify for if you didn't have the private mortgage insurance? So there's some banks that offer these programs specific to low to moderate income buyers, where you can put as little money down as possible and still not have this private mortgage insurance. Now, let's say you are getting a mortgage that has this type of insurance on it, okay? Typically, that's going to be a regular secondary financing type loan. Now, if you have private mortgage insurance, the rule of thumb is once you've gained 20% equity in your property, then the insurance falls off and it goes away on conventional financing. Okay. If you put 20% down, you ain't got to worry about it. You don't have it. Okay. Now, if you're going for FHA financing, this is kind of the kicker here. With FHA, as lenient as they are with the credit scores, as lenient as they are with the down payment, as lenient as they are with the debt to income ratio, you're going to have to pay private mortgage insurance regardless of how much you put down. Okay. Now, how long that mortgage insurance is on the loan is dependent on how much you put down. All right. So if you put down 10% or more on FHA financing, then the mortgage insurance goes away after 11 years. If you put down anything less than 10%, then you're going to have private mortgage insurance for the life of the loan. And the only way to get out of it is to refinance it into a conventional mortgage. Okay. Right. So before you begin, we want you to understand the different phases and what to expect when it comes to getting into this process. Okay. So the first thing you're going to end up doing is getting a pre-approval or a pre-qualification. Now, you hear these words all the time. You know, I'm going to get pre-qualified, I'm going to get pre-approved. There is a difference between the two. A lot of times lenders would use these interchangeably, meaning the same thing, but ultimately there is a big difference. And what I would recommend is, you know, whatever term your lender is using, just make sure what they're doing is actually, you know, what am I trying to say? So, okay, back up. Pre-qualification. What is a pre-qualification? Technically, a pre-qualification is you come to me, you call me, say, hey, I've got a 740 credits, or excuse me, 740 credit score. I make $6,000 a month. You know, I've got $30,000 in the bank. Based off of that information, can I get qualified? If you tell me that information, that's, you know, if somebody comes to me that truly has that information, yes, you're pre-qualified. Based off of that verbal information you gave me, you're pre-qualified. Now, pre-approval takes it a step further. You tell me you got a 740 credit score. Okay, let me pull a credit report. Credit report, pull the credit report. Yep, you got a 740 credit score. I make $5,000 or $6,000 a month. Okay, show me your pay stubs and your W-2s. Based off of that, okay, good. Okay, and oh, I got $30,000 in the bank. Okay, show me your bank statements. Show me this money that you have in there. Okay, so I've reviewed your credit, I've looked at your pay stubs, and I've looked at your bank statements. Based off of all that information that I verified, you are now pre-approved. So that's the difference. So one is verbal, the other one's actual verified. Now, some lenders take it even a step further and say, okay, all this information I verified, I'm going to have an underwriter approve this information. Okay, so they're going to send all that information over to an underwriter to say, yes, you're approved on here. All you have to do now is go find a house. Okay, so so back to what I was trying to say. Regardless of what term your loan officer uses, make sure they're verifying the information that you're submitting to them. Make sure they're looking at your pay stubs. Make sure they're looking at your credit report. Make sure they're looking at your bank statements. Because there's many times that things pop up that we may have to have an answer for, or something of that nature. So I think, you know, the true pre-approval is the route you want to take. But regardless of what your loan officer calls it, just make sure they're actually pre-approving you. Make sure they're actually verifying the information that you're telling them. Okay, so you want them to pull a credit report. You want them to review your credit, your income, your assets, all of that information. You want them to review that. Okay, so with that being said, gather your documentation. All right, gather your pay stubs, gather your bank statements. Make sure and give authorization to pull credit report, do all of that. All right. Okay. So you get approved or pre-approved, you go, you find a house, and the next step to do once you find that house, you get a contract, purchase contract, fully executed purchase contract. The next thing we're going to do is lock your loan. So what that means is that we're going to quote you an interest rate, and we're going to say, okay, we can offer you a 30, 60, or 90-day lock, which would be the lock period. Now, what we mean by that is that we're guaranteeing this specific interest rate on this day for these many days so that you can close. Once you close, it's for the life of the loan. So let's say you come in and you're getting a 6.5 interest rate, but you're on a 30-day lock, 30-day lock period. That means you have 30 days to get your loan closed. Otherwise, the lender doesn't have to honor that 6% or 6.5%, whatever it was. It could be a 45 day, it could be 60 days, 90 days. So when they say they lock your rate and you close before that lock period expires, then that's great, because that means you're locked into that rate for the life of your loan because you've closed on your loan. Okay. So rate lock, got your rate locked. You got your rate locked, excuse me, tongue tied there. Next step is to underwriting. So all that information, remember, the credit, income, and assets, all the documentation, things like that, and the collateral information, the home, because remember, at this point, we're also going to start looking for other things about the property itself. Do you have enough insurance coverage? We need a survey, we need to get the appraisal, those things to determine the value. All those things get sent to an underwriter. The underwriter reviews everything, and then they say yes or no, approved, conditionally approved, or whatnot. So let's say you get your full loan approval. Okay. The underwriter says, yes, you're cleared to close, full loan approval. You've met all of the requirements to purchase this home. Next step is closing. And this is where you're trying to get, right? This is where you want to be. So, what time do I have? Okay, I got a few minutes. So at this point, this is where, everything gets really, really exciting. We move your file over to the closing department. The closing department works with the title company to prepare all your closing documents. Us as a lender, we prepare to send your loan funds over to the title company so that they can disperse the loan. At that point, everybody signs their documents, the closing documents, and boom, you are now a homeowner. Great stuff. All right, so a quick overview of the loan documents and what they contain. So a pre-qualification letter or a pre-approval letter, this is that you're going to receive at the beginning. So when you come in and complete a pre-approval application, if you're pre-approved or pre-qualified, whatever your lender uses, they're going to give you a letter that states that. They're going to give you a letter that states, we've reviewed your credit, income, and assets. Based off of that information, you are pre-approved or pre-qualified. And then along with that, typically we're going to give you what's called a closing cost estimate, a closing cost worksheet, a pre-approval estimate, or something like that. But what it is it breaks down the initial or estimated fees that are going to be charged to you at closing, including what your estimated interest rate is, your estimated payment, estimated taxes, insurance, closing costs, what your cash to close is going to be. Typically, that's what they're going to give you. Pre-approval letter, we kind of touched on that with the pre-qualification letter. Once you've made full loan application, meaning you've got a house under contract, your lender, you've got a house under contract, the lender has all your documentation, they're going to give you what's called a loan estimate. So based off of that loan estimate is what's going to more solidify what those closing cost numbers are going to be. So now that we have a property, we have a better idea of what your insurance is going to be. We have a better idea of what your taxes are going to be based off of that property. So what this loan estimate though this is what kind of puts those numbers into play. When I say that, that means is when you get to closing, you're going to have what's called a closing cost or closing disclosure. I think we might touch on that. Yep, we're going to touch on that here a bit. So a closing disclosure, we'll touch a little bit on that, but basically these two things match, the loan estimate and the closing disclosure. So the loan estimate's at the beginning, the closing disclosures at the end, typically they match. So as a lender, we have to tell you what fees are, and there's not a whole lot of wiggle room on majority of those fees. Now, there are some fees that we have no control over. For instance, your taxes and your insurance and things like that. But the loan fees themselves, origination fees, processing fees, anything like that, those type of fees, there's not a whole lot of wiggle room. So they'll match what that closing disclosure states. Loan application, Form 1003, you'll hear lenders talk about, or loan officers say that 1003, that's just what we call your official loan application. So all that information that we got from you at the beginning is put in a formal loan application, an actual application. And that's what the underwriter uses to underwrite your mortgage. And then the closing disclosure. The closing disclosure, again, typically will match the loan estimate on majority of the fees. There are some fees that are different, but the closing disclosure is what's going to solidify every single final fee. And you'll sign that at closing. Deed. Once you close on the house, you're going to sign a deed. What that deed is, it just shows that you have ownership in the property. Simple as that. All right. So don't let any of this confuse you. We went through a lot within a very short period of time. Trust me, I could go on and on about this, and I typically have longer when I'm talking specific about lending, but don't let this intimidate you. This is we do this all the time. Work with a trusted home buying team. Oh, look, there it is. Build a trusted home buying team that can guide and educate you every step of the way. What I always say, you guys are coming through Habitat for Humanity. You've probably got a good relationship with your housing counselor. What I would recommend, if there's something that you're just not comfortable with, go back to them. Go back to your housing counselor and talk to them about it. Maybe the loan officer you're working with or the real estate agent you're working with isn't the best fit for you. Let them help you through that, okay? Because that's the thing. I want to work with individuals that are comfortable with me and that can trust me. If you don't have a whole lot of trust in me, then it's really hard for me to do my job. And I don't feel like I'm doing my job if I can't, get you to trust me. So I want you to work with somebody who you completely trust, that's going to guide you through this process every step of the way. Because again, this is one of the biggest investments that you'll probably ever make. So, you want to do it right. You want to do it right. Again, if you don't know, just ask. I'm a firm believer that there are no dumb questions. Matter of fact, the only dumb questions are the ones that are not asked. So ask away. I think we got a few minutes for some Q&A. So I'm going to turn it back over to Aretha and let her kind of go from there.
All right, Daniel, thank you so much. Again, a very awesome presentation. You gave them so much information in this short period of time. And I hope that you all, like I said, were taking notes because like Daniel said, this is probably the biggest investment that you all will ever make in your lifetime, buying a home. And there's so much to navigate, going through the home buying process. And our job as a counselor is just to help you understand the process, educate you about the process, the different terms, which is one of the reasons why we have this class, and we offer it. We offer classes like every month. So these classes are very, very important, especially for first-time home buyers. Like you said, like I was saying, our goal is not just to help you get into a home. We want to make sure that you're in that home for the long haul. And this is the best way to do it right here, is by educating yourself about the whole process. Like Daniel said, you need to be in contact with somebody that you trust. I can vouch for Daniel. I've worked with him for years, and I know he always has the best interest of his clients, whomever comes to him, whether he's working with you or not. If you call Daniel and ask him a question, he's going to be very honest and very transparent with you, and just very down to earth. He's not going to sugarcoat anything. He's going to tell it just like it is. And that's what you need from a loan officer. You also need that from your counselor. For those of you that have worked with me, I don't sugarcoat anything. I give it to you just straight, just how it is. And this housing market, right now with the interest rates where they are, it's one of those, it's tough to navigate through, but it's not impossible. You can do it, okay? But you have to be educated about the process. So when you have signed up for Dallas Habitat, these classes that we offer, you've already paid for them. Come to these classes. This is the only way that you're going to learn. And this is just reiterating everything that we're telling you in these counseling sessions. And so again, Daniel, we thank you so much. Like I said, this partnership with you is just so awesome. We appreciate everything that you do. I did see, well, it looks like we might have some more questions come through. So let me see what we have in here. We have one question that says, do any of the mortgage options cap the interest rate?
Let me make sure. Yeah. So the question on that depends on the type of mortgage, of course. There's a thing called a qualified mortgage that lenders have to go by. And what that means is that if we offer you an interest rate, it's considered a qualified mortgage. So a lender is protected in providing you that mortgage if for some reason, you were, if something happened, you got disclosed and then, or foreclosed on, and then, these regulatory agencies got involved in things like that. We have to prove as a lender that we've done our due diligence to make sure you truly qualify for that mortgage. Now, with that being said, lenders do cap the interest rate on how high they can go, but a lot of it's going to be dependent on, oh gosh, what is it called? So without getting, too far into it, we base interest rates off of mortgage-backed securities and all kinds of things on the back end. So to make sure we're still staying with it compliant, yes, some of them are going to have caps as to, okay, we can't go this high on a rate because, otherwise it wouldn't be a qualified mortgage anymore. But, a lot of it depends on the mortgage product. There's some lenders that are offering, loans that aren't considered QM qualified mortgages or something like that. And they kind of have these crazy rates and crazy options on them. But talk to your loan officer about that. And they could probably give you more specific answer, if you're talking about a specific mortgage product.
All right, and I hope that helped the person that asked that question. We also have another one that says, if rates drop during the lock period, do lenders typically offer the lower rate?
So to answer that, typically, no. Now, with that being said, that doesn't mean that they won't. You can always ask. I know with our bank, with actually several of the banks that we work with, once you lock in, you're locked in. And really the purpose for that is really to protect you if the rates go up, because typically rates are on the rise. Very rarely are they going to drop enough for even to make a difference for you. So there are, I think the ones that would offer what we call a float down would be those who are building a new home. So it's going to take, 6 months, 8 months to build. So then we'll say, okay, you know what, we'll lock it for that long to give you that chance to get your house built and close on it. But, if the rates drop, by chance during that time period, then yeah, we'll honor the lower rate. But if you're doing like a short-term rate, which is 30, 60 days, something like that, 9 times out of 10, they're not going to offer that option to drop that interest rate if they go down. But in this market right now, rates are going up. So, I think at this point, it's really not an issue. It's in your best interest that they don't change the rate. So.
All right. Thank you, Daniel. Appreciate that. And that was the only other question that we have in here. And again, like I said, I'm one of those that I will always want to be respectful of your time. And so I hope you all have enjoyed this session this evening. Again, lots of great information, especially if, like I said, if you're going through this process, it's very important that you compare your loan options and just see what's out there. So thank you so much. And I just want you all to know, like I said, we can't stress education enough. And I want you to know that our next class is going to be on Tuesday, October the 25th, and it's on budgeting, so how to develop an effective spending plan. And that's going to be with our partners with Comerica Bank. So be sure to register for that class and attend that one if you can. Again, that's Tuesday, October 25th from 6 to 7 p.m. And again, I hope you all, let's give Daniel a round of applause, and I hope you all just enjoyed this session. And thank you again for just attending. Daniel, we appreciate you.
Thank you guys for having me. Appreciate it.
Yes, you're very, very welcome. Thank you. You all have a good evening, and we hope to see you at the next class. All right, bye-bye.